Okay, let's get underway. I'll just advance the slides. Good evening, everyone, and welcome to tonight's BullCharts user group webinar. For all BullCharts users, we're getting underway. Please remember the disclaimer. For all of our BullChart sessions, none of the information that we present or discuss tonight is advice of any sort. It is only opinion and should not be acted upon. If you do happen to take any tips and make some money, please share it with us. We'll all be much appreciative. Here's the agenda that I was planning to use in our Melbourne meeting last week and in this week's session. The plan was initially to talk about the supplied scans in BullCharts, and then Des said to me that he's got some updated material he'd like to share, and I thought that's high priority and the scans can wait. So in last week's session, we went and did this bit here that I'm highlighting now. Des presented to us some information about trailing stops. Are they effective or not? And that's what Des will do tonight for us. And I'd like to thank Des before we get started, as well as afterwards. Here's a summary in the notes there of what Des shared with us last week in the Melbourne meeting. And I won't go through it because that's preempting what Des will share tonight. But that's there in the minutes. And if there's anything new included tonight, I'll certainly add it in, and any other material that comes up. For those who might come to Melbourne, we're meeting at a different venue the last few months in Chadstone instead of the old place in Oakley. And I've locked in the dates for next year. Now, for those of you who don't know, Des is a regular in our Melbourne user group meetings that we've been running in Oakley for a few years, but now in Chadstone. Des likes spending lots of his time during a weekday on the computer, running BullCharts and playing with BullChart script, and writing new indicators and testing new strategies and all sorts of things and using real test software to do some back testing. Des does a lot of that. And he's already presented to our user group 3 or 4 or 5 times. I've lost count. Those presentations are all up in the Google Drive for those people who would like to have a look at any of them. If you don't have access to Google Drive, just send me an email and ask for it, and I'll certainly make that happen. So Des, if you share your screen, we're looking forward to you telling us all about, that looks like it, telling us all about trailing stops. So with a round of applause, Des, we'd like to make you welcome. Thank you. It's over to you.
Thank you, everyone, whoever that one person was. Good evening, everyone. Great pleasure to be back here again. I guess some of you would know that, as Robert has said, I quite enjoy playing with charts and BullCharts and programming, and that's my background. And admittedly, sometimes I can be accused of going a bit overboard when I come up with some charts and indicators that confuse the devilment out of everybody. So I was sort of sitting down thinking, well, let's go back to basics and see whether, if I cut away a lot of the overhead that I put into some of this stuff, can we still get some meaningful insights into what charts are doing? And I thought a reasonable place to start would be trailing stops. And in the vein of that thought, just how simple can I make it, or how simple can it be? So that's I guess the background to what I've done here. And then I've sat down over a period of some weeks, because it'll all come out here in an hour or so. But when you're actually in the depth of it and going down lots of rabbit holes, it does take quite a bit of time. So onwards. This is the agenda. Happy for interruptions. Robert, perhaps if you could monitor any questions that come and let me know. It's all about trailing stops, and I guess everybody on this webinar should be familiar at least with trailing stops. They've been around for donkeys, very well known. In principle, they're simple, but of course, in many things in life, the devil is in the detail, and I was surprised to find out how much devilment there is in this little enterprise. So, Are trailing stops useful? Are they really useful? Are they effective? Can they stop you getting getting into trouble? And probably more importantly down the track, is there a system you can put together based around trailing stops that's actually tradable and profitable? Because if you like, all of the above is of academic interest, but if you can't actually make a buck out of it, it probably isn't going anywhere. So very quick overview. We know what a trailing stop is. It's a stop loss line that we have some parameters around that will move up and will never move down. And if you fall below it, that tends to be an indication that things are going pear-shaped and we want to take exit action. I'll talk about BullCharts has a number of trailing stops. Have a quick little discussion about those. They and many of them need to be manually reset, and that has some issues. I'll show how I've looked at it and how I automate the resetting process for the trailing stop. And then we'll get more into the guts of it. Can that sort of trailing stop become the basis for a trading system? In its own simplistic form, just the trading stops by itself, it's probably just a bit light on, and we probably need a few more other things. What can we put in there? What other criteria can we put into the system without it becoming overly complex, burdensome, and difficult to manage? Then, proof of the pudding's in the eating. Let's look at some test results, and we'll see whether those are good, bad, or indifferent, each to their own. A little caveat here. My basic trading premise is I only trade long. I trade predominantly with a weekly time frame, and everything I do is weekly charts. That tends to be my view of the world. Sometimes I go down to daily, sometimes I go out to monthly, but by and large, I have a weekly time frame, and I think of myself as looking for trends and trying to catch the trend early enough to take some benefit from that trend. So that's my thesis, my background, and now I want to apply that to trailing stops. As I said, within BullCharts, there's a number of stop losses, trailing stops that are available. If you click on the indicator button and pull down the category of stop losses, you'll see there's 10 or so trailing stops. Some of those are better than others. Some are predicated around the system. So the JB is Borg, his trailing stop. I know Robert has liked in the past used the Wilson ATR. Jimberg. Yes. So the Wilson ATR is a popular choice for many. It's on the chart here. The red line is the trailing stop. It hangs below the price action whilst you're in the trade. It steps up and stays a number of ATRs below the price action. When you put that on, one of the requirements for running the Wilson ATR is you have to actually place the starting point for that trailing stop. One of the good bad things about a trailing stop is that the good thing is that the trailing stop goes upwards, and that's great. But of course, if you only ever let it go upwards, in a sense, it'll go off the top of the screen, and you'll never ever, unless you get a huge breakout, you're never ever going to get back into that trend. So you have to keep resetting the trailing stop to bring it back down to where the price action is. A lot of trailing stops have this demand that you drag it and manually place it. And it is, in my view, far better if you can automate that process, which is what I do. This is I started by saying I want to look at trailing stops, and I said I wanted to keep it simple. And this presentation is based around a 6% trailing stop. So I'm placing the trailing stop 6% below the highest latest close. And that's what this black line on the chart here is showing. That's 6% below the most recent high. But you'll see along the bottom little black tick marks. And you can see that when you get a tick mark, the trailing stop resets. So I choose to reset this trailing stop at those tick points. Now, those tick marks are not random, thank goodness for that. Those tick points are driven by the ribbon along the bottom. And that ribbon along the bottom is essentially Guppy's multiple moving averages. And if those of you that have looked at the Guppy moving average, you'll know that it's all about having a sequence of fast moving averages and a sequence of much slower moving averages, 6 of each. And things are good when all of the fast moving averages are above the slow moving averages, and things are bad when all the slow moving averages are above the fast moving averages. When you look at that chart of those moving averages, if you're in a good place, so they're all above, you've got a green bar in terms of this ribbon. If things are bad and your slow moving averages are way below the fast moving averages are way below the slow moving averages, you've got a red bar, and then the orange and the pink on this ribbon are where you've got a transition phase. All I'm interested in is whenever those moving averages tell me that it's go, 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 all green. And on the ribbon, you'll see that I've just highlighted in blue the first bar of each green sector. And the blue says, we have had, in my opinion, according to the Guppy moving averages, the blue tells me that we have had a change in trend to an uptrend. And I make the decision then that if I've had a change in trend, I'm going to reset my trailing stop at that point. So if you go along the ribbon at the bottom, you see the first little blue tick. Above that, there's a black tick, and the moving average is reset there. The next blue tick, the moving average is reset there. Now, the next one is probably the most difficult one in terms of this chart, because you can see that when the next tick happens, it's after a big period of downtrend. So the multiple moving average has captured quite well that that's in a downtrend. I said, stay out of here. We don't want to get back in. If you look to the words to the left, the summary of that is, I reset the trailing stop as indicated by the multiple moving average band. That's the little black tick on the chart says that's what's happening on the chart. When we're above the trailing stop, that's goodness. When we're below the trailing stop, that's badness. For the sake of documentation within the bars themselves, I color them so blue would be trailing stop. Sorry, within the bars, blue says I've just closed above the trailing stop. Red says I've just closed below the trailing stop with a loss. Dark green says I've closed below the trailing stop with a profit. And then lime green is we're above the trailing stop, and pink is we're below the trailing stop. I hope that's reasonably clear. We'll have a look at some larger charts. When I presented this last week, all those greens were a bit indistinguishable. I can clearly see 2 shades of green on my chart, but then I am from Ireland. I hope you can all see that. I have chosen to use the multiple moving average as my reset criteria, but you can use what you want. And as an example, on this chart, I've put ribbons at the bottom that would give you a different reset criteria that you may want to use. And for this example, the examples here, I've used the golden cross of AMA 5 crossing over EMA 12, or 9 on 21. That's quite a popular combination, or 50 on 200. Each to their own. So I have chosen the MMA because I think it gives reasonable results. You can see that there is a trade-off. If you had used the bottom 50 on 200 golden cross, you'd see that there's almost no resets. And that may be good for you, may not be too good for you. I'd say that's not really useful in my analysis. I think you want a reset that's sufficiently frequent that you're going to re-enter into a trend, but not too frequent, so that you're whipsawing in and out and resetting left, right, and center. Choose what you want. I choose to use this multiple moving average, and that's what the rest of this presentation is predicated upon. So if I wanted to make a very, very, very simple trailing stop system, I could do this. I could say, use the reset mechanism to reset the trailing stop. I'll buy when the price crosses above the trailing stop line. I'll sell when it falls below. And the big question, the point number 3, is that a viable trading system? Well, on this chart, I've put in the arrows. Blue is an entry point. Green is an exit point with a profit. Red is an exit point with a loss. And if you follow your way through there, you'll see blues followed by either a green or a red, blue, green or red, and so on. And the green bars, the green down arrows say that's an exit at a profit, and the red down arrows say that's an exit at a loss. And this example here, if you count the little moving dots, count the arrows, there are 9 wins, so there are 9 green arrows, down arrows, and there are 7 losses, that's 7 red arrows, from a total of 16 trades. Now, looking at that, you can pass a judgment as to whether you think that's profitable or not. But it's kind of hard just looking at the chart to make that determination. So, of course, only the numbers tell the truth. So you got to look at the devil's in the detail, and this is the detail of that trade, of those trades. So this is the same piece of chart, and there are 16 trades. I've only got, I typically look back 220 bars. The vertical orange line is 220 bars ago, which on a weekly chart is about 4 years worth of data, which is as far as I choose to go back. But what I've done on this chart is along the bottom, and apologies for being a bit hard to see, but along the bottom, I have calculated the profit or loss for each of the individual trades. If the number's in red, it's a minus, so it's a loss. If the number's in green, it's a positive, so it's a winning trade. You can see that towards the left-hand side, there's a 59.44, which would be this this winning trade on the large upslope, followed by another winning trade of 21.6, I think that is. So along the bottom, we have for each of the possible trades, there's a profit and loss. I do the right thing here in that when I get a buy or sell bar, I take the trade as the open of the next day. So I'm not trading it in the market on the day the decision is made. I wait till the next day to get the open of the next bar. And then if we add that all together and summarize it, you'll see that that set of 16 trades provided a profit of 156% and a loss of 34%. And that's a ratio of 4.6 to 1 of wins to losses. So actually, you look at that and say, that would have been a good bit would have been good to be in that stock over that period of time, because I would have won 4 times what I lost. When I saw this, and if you obviously went through lots of charts, this is true for about half of the stocks that you look at, or that I looked at. True for about half of the stocks. So we're saying half the time, if you pick ones that have got a good win-loss ratio, you'll be ahead of the money. That sounds good. Let's look a bit further. What I've done here, again, same details as before, but what I've done is I've added up the profit and loss on a compounding basis. So take $100, in this case, the first trade was a 6% win. Take the $106, put it into the second trade, whatever that is, compound that across until you find out what the real win would have been if you'd invested $100 into those trades at the beginning of time. I then discount that according to the time in the market, so that if so before I do that, I divide by the number of years to get an annual basis. Then I add a time in the market factor that says if over this period of time I've been in the market for 10% of the time and I got a return of 10, that's what is far better than a return of 10. Let's go back one. 10% return over 6 months is better than 10% return over 12 months. So I take the time in the market, factor that into the annual rate of return, and I come up with this trader's profit. The right-hand side there, 115%, 114.9. That represents the annual profit of these trades compounded over that time, allowing for the time in the market. So the bigger that number is, the better it is. I also calculate here some other bits and pieces of information that I find useful. Maximum drawdown, 13%. Even though this has a trailing stop of 6%, sometimes it will fall through the trailing stop, and that's when you get a bigger loss than otherwise would be the case. And there's a great example. The very last bar on this chart shows that even though this is a winning trade, it's gone right through the trailing stop, and it's closed well below 6% from the most recent high. But that's the fun of trading. That drawdown, I divide into the T profit to calculate the number that's on that screen of SPQR, which I happily think of as sleep, peace, and quiet ratio. So the higher that ratio is, the better your profit is, and it allows you to compare one trade, the trades in one stock with trades in another stock. So the SPQR, the higher that is, the higher the return is, and the safer the trade is, because you want that to be as high as possible. And here I've also put in rate of change, 44. S is for smooth, W is for weighted. So that's my smooth rate of change using a weighted moving average of 4, and that comes out at 44. And an unbalanced volume over 15 bars looking back at 18%. I put those up there because I use those later on. So that's a trading system that has some promise, but is it really worthwhile? And to answer that question, you've got to do a back test. Unfortunately, BullCharts intrinsically doesn't incorporate a back test tool. So I have in the past used Amy Broker, but I am now, I use Real Test, which I think is a very, very good back test tool. But before you get into putting that into a back test, I ask the question, if you look at this chart of 360 as it is, of those 16 trades, do I really want to enter every single one of them? Or can I avoid some of them and only pick the better ones that are available to me? And the answer is, of course, I want to pick the better ones, which then brings the question, how do you decide which of those possible trades, not just in this stock, but in all the stocks that are available at this point in time, which of those trades are the ones we should take? So looking at putting together a trading system was sort of, it's pretty obvious. The first bullet point is the price has to be above the trailing stop, obviously, because we're looking at trailing stops. And if it's below the trailing stop, we're in all sorts of pain. The price should be in an uptrend. And I try and address that point by resetting my trailing stop line according to that multiple moving average. So I think I'm catching the beginning of the uptrend there. I want the stock itself to be in an uptrend compared to the other stocks that are available at this time. And I use this parameter that I indicated on the last chart, this smooth rate of change using a weighting moving average. And I put the code there, the BullCharts code. You can see that it's a moving average over 35 bars using W for weighted methodology. And what am I taking the moving average of? I'm taking the moving average of the rate of change of the close over 15 bars on a percentage basis. So that is the number that I say represents the intrinsic strength of a stock that is in an uptrend. And I put out there that this should pick the best of the rising stocks. It should pick the better rising stocks, the wheat from the chaff. Not infallible, sadly, but I think it does a reasonable job. Another way to pick good entry points is, personally, I like to obviously only trade liquid stocks. I put a liquidity filter on depending on the day of the week and the way the wind is blowing. I don't like to trade anything that's got less than between $3 to $5 million of value trading in a weekly basis. So I add a liquidity check. I don't have the skill, the experience to trade very, very small stocks. I take then as an example for this presentation, let's just take the five top stocks according to that criteria. And if one fails and falls below the trailing stop, throw it out and then bring in the next one. And that can form the basis of a backtest system. You then can add as much as you like to that. I am not being prescriptive. I offer this as a basis that you can build upon, because what you decide to buy is entirely down to you. But I choose to give you some hints, if you like, the way I would do it. I think volume should be rising, and there's lots of ways of measuring volume. I tend to like the on-balance volume, and I do it over 14 bars. So I say, let's look at the volume over the last 14 bars, add all the ups, add all the downs, take one from the other. That'll then give me an unbalanced volume. And then I look at the rate of change of that unbalanced volume. So if a stock has got a bigger rate of change in its unbalanced volume, so it's going up in terms of its volume more, I think it's got a better OBV, and vice versa. I would always do a visual check, and there are some things you might want to look for that you would discount a stock on a visual basis that a simple algorithm like this won't pick up. And you always have the right to say, oh, I just don't like the look of that stock, or I don't like the stock, full stop. It's an oil stock and I'm dead against oil companies or tobacco or whatever, your choice. And then the last thing you do, certainly when it comes to the back testing, is I have thrown out here a couple of parameters that I have looked at and think are reasonable. So I'm saying that the trailing stop should be 6%. I've looked at 1%, 2%, 5%, 10%. 6 is a number I'm comfortable with, but you can use a different number. I have used the smooth rate of change W, the SROC, of 15 and 35. I think quite good results come with 10 and 40. And I have back tested 5, 10, 15, 20, 25, 30, all the numbers, both those numbers between 1 and 100. And I think that somewhere around 15 to 35 gives results that are meaningful and better than some other combinations. But they're not perfect. And when you play with parameters, there are lots of numbers that you've got at your behest. How many stocks do you want to trade? Here I'm saying 5. Do you want to test them at 10, 5, 7, 8.5? All those are numbers that you can play with. The more things you play with the parameters, obviously the more tests there are, and no two people will arrive at the same set of parameters. If I run that test with just that system we've just shown you over the all ordinaries, that is the equity curve as pushed out by real test for the last 500 bars. So that's roughly 10 years. As an equity curve, that's not too bad. That's at over 200 weeks, 200 bars. You can see it's flat there over 22, and that is just the top half of the previous chart. Here is that chart in numbers. So this is 500 weeks using that system against the All Ordinaries. The test 1 through 10 are each of the years in those 10 years. And if you look at the net profit column, which is the fifth column from the left, you'll see that in the year of 2015, it gave a $36,000 profit with a rate of return of 43%. The next year, all of those years are in profit with the exception of 2018, which gave a 31% negative rate of return. On aggregate, it gave a rate of return of 48.6. Now that's a good rate of return, absolutely. But is it right for you? It's also, there were 499 periods over that time and 424 trades in that time. That's sort of one a week. Is that good, bad, or indifferent? Too many? Too little for you? If you change some of these parameters, you can change the number of trades so it's less, so that it's more. And that, of course, then has a knock-on effect as to the rate of return. I point out here the way Realtest does the maximum drawdown. That is not the maximum portfolio drawdown. That is the maximum per stock drawdown. So when I ran this test, I ran it with $100,000 initial investment, 5 stocks, so $20,000 per stock. And that 57% drawdown means that over that period, the worst stock had a drawdown of 57%, so it lost half. It lost $11,000. So that's the per stock maximum drawdown, not the portfolio drawdown. And then all the other numbers there are, as you'd expect, giving you an enormous amount of detail. That is, if you take the top test, the 499 periods over the 10 years, that is the set of trades, or the most recent set of trades within that portfolio. And you'll see the top 1, 2, 3, 4, 5, they say end of test, and that's because they've closed that down because that's the last bar of testing. That's this is dated the 12th of the 9th, which was at the weekend when I put these slides together. So the test obviously finished then because there was no more data to run with. All of the other ones below it, their exit reason is the trailing stop exit. So all of these other ones had an exit because they fell below the trailing stop, and the percentage loss or gain is shown, the profit loss or gain, yada, yada, yada. That's just an example of the information that Realtest will give you. Again, using Realtest, if I can ask it to run a simulation and then tell me that on the date of the 12th of September, which is the weekend, what would be the top stocks to buy. You can see on the right-hand side, it says Best Buy 1, 2, 3, 4, 5. It gives you the stock in descending order, and they are ranked by the rate of change, 1535. That's the rate of change that I discussed a little bit earlier on. So the top one, CAT, had a rate of change of 31%, 32%, and then the top 5 of those would go into this portfolio if you were to run it as of the weekend and go into new trades this week. Coming back to a BullCharts view of the world, this is the same scan run within BullCharts, and this, you can see the R1535 strength column. It's sorted by that column, so this is picking up the strongest of the stocks that are available for purchase according to that strategy. And happily, for me, very happily, the stocks that are pulled up by BullCharts are in fact the same stocks that are pulled up with real test. So that's a happy confirmation, with the exception of the fourth one, KPG. And the reason for that is I've applied a liquidity criteria of 3 million on in this test. So obviously under real test, it says the volume was 7.6 million. When I go to BullCharts, it has a volume of 2.5 million, whatever it was. So it doesn't meet that test. And that's because BullCharts volume data differs from real charts volume data. Within real charts, I use Norgate data. Within BullCharts, I'm using the BullCharts data, and the volume component of that does not match up because BullCharts only takes the SX, doesn't take Chi-X and some other things. Norgate data includes more. So I would expect that if there are anomalies between the two lists, it's because of a data mismatch, a volume mismatch in the data. And I'm quite composed in that if I push the data, the volume limit on this test down to a lower number, that stock would KPG would appear in this list too. So what I'm saying is both these systems are giving the same results, which is very comforting. Calls into question though the different equity curves can appear for different reasons. The two equity curves on the left are 200 weeks. The two on the right are 500 weeks. So the one on the left is just a blow up of the last half of the one on the right. But you'll see they differ because the top chart is on the left is using the ASX game list of stocks. And because I was playing in the ASX game, I was running with a list of their stocks so that I could put some trial trades into their game situation. The All Ordinaries 200 gives a different set of results, and in this case, somewhat better. It is a different set of stocks, and this is an example of where different universes, different time frames, what's best for you. You have some decisions you have to make here, and I can't make those for you, but I can look at some summary information and come up to conclusions that work for me, and I'm happy to own up to those. As a proof point external to a PowerPoint, I ran this philosophy for part of the most recent ASX game. So I've been playing with it, and this is the results. The ASX game, as Robert said earlier, has closed. This is the result of my portfolio in the game just closed. Full transparency, you can see my name's at the top, and the date is the 13th of September, so that's valid. Overall ranking I obtained was 257 from 7,000 portfolios on a national basis, or 73 from 1825 in Victoria, putting this strategy and this portfolio into the top 4% of that competition. So I think it has some value, and that is a proof point that you might think is valid. Here are some more proof points. I presented this to the BullCharts group in Melbourne last Tuesday, which was the 17th of September. And in terms of horses for courses and different universes, how that ties up, what I've shown here is, as I normally would do if I present to BullCharts at a point in time, the question always comes, yeah, well, what happens now if you did this? So what I've shown here is 4 different universes, and I've run the scans to pick the top stocks for these 4 different universes, and I've run them as of the evening of the 17th of September, which is when the BullCharts meeting was. So those scans are at the close of business on the 17th of September. and then I've bought notionally in the spreadsheet. I bought at the buy price, which is the 18th of September, and then I've put in the latest price for each of those stocks as of 5 p.m. today, and calculated the percentage delta. So if you look at the top left-hand corner, that scan is 5 stocks from the whole of the ASX. So that's whatever it is, 2,000 odd stocks, and it's come out with an average performance of 9% over that portfolio over a space and time, which is only a week. And that's unusual. And there's a fair bit of volatility in that, I would guess. Top right-hand corner was the ASX game. Although the game's no longer running, that's from the list of stocks that are available in the ASX game. Again, if you'd bought them on the 18th of September last Wednesday at the open, those are the buy prices. Latest sell price, or the latest price as of 5 p.m. today, that's the delta of 3%, which is still very good, but it's a bit lower than the 9. Bottom left-hand corner, this is the X500, SX 500. Same again, run the top 5 stocks as of close of business on the 17th of September, buy price, sell price, and gives an average across that portfolio of 18%. In a week, I'm going, that's too good to be true. But that's what the numbers, they don't lie. On the bottom right quadrant, I have the SX 50. So how that would go over that period, and it actually makes a loss. And that doesn't surprise me. If you think about how a trailing stop with a rate of change entry selection criteria, if you think about how that would work, it favors volatile stocks. It favors therefore more often the smaller stocks that will run more rapidly. The big top 50 stocks don't really work in that way. They're slower moving, longer term trends perhaps for some of those. So it doesn't surprise me that the SX 50 didn't perform terribly well. And across over that period of the week, I put the XAO and the XJO, which has moved barely, has not moved the needle at all over that period. You can look at that and say, great, I'm going to go to the left-hand bottom corner and go for that. What I really want to emphasize here is that there is opportunity depending on what universe you take, which parameters you take, which time frames, how many stocks, all of that. There are ways to tune this to your liking, but I would claim that these numbers show that there's a credible way to do it and to be profitable. Now that is a period of time of 1 week, and that means nothing in the scheme of the universe. So I'm looking to move this forward, follow this further forward, doing my back testing. One of the problems with the back testing at the moment, I think, is that the number of trades is uncomfortably high for me. It's sort of 1 a week. I'd like it to be 1 a month or 2 a month or something like that. But to do that, the return will drop. The drawdown may or may not drop, but certainly the return might drop in that. And that's pretty much where I've got to on thinking about trailing stops. I think they're useful, which answers one of the bullet points in the very first slide. I do tend to overthink it. Apologies, but that's me. But I think that by not overthinking it, you can still end up in a very good place. As I say, it can be part of a simple and effective system, and it can actually be the major part of that. The universe that you want to choose is not just, am I doing the SX 500 or the SX 200? It's, which I didn't point out here, is I exclude stocks that are less than 20 cents. So that's part of the rules for my universe. You might have a whole heap of other rules that you might want to apply. Rank the stocks according to your chosen criteria. In this example, I've used that SROCW at 1535. I think it has some worth. But if there's something you find better, go for it. I'm not being prescriptive. As I say, adjust the criteria of your own comfort. As many parameters as you like, they're in there. You can optimize. There are millions of options you can come up with and find the one that works best for you. Robert will has the presentation. He'll put that up on the site, I'm sure. Everything I've shown here, the code is freely available to everybody, rather than burden Robert with asking him to look after all of that. If anybody wants any of that code, any of the indicators, or whatever, any of the scans, just drop me an email, and I'm happy to send that to you. And that's me pretty well done for the presentation. Happy to look at any particular stocks that people want. This would be a typical view of the world. And what can I show you here that's of sense? When you start looking at some of the smaller stocks, not that one. This is where this system, this sort of stocks, it tends to pick. And you can see that CU6, wherever that is, has had no volume to speak of. And then it begins to break out in volume. And if you look at the on-balance volume, maybe, yes. You can see there the on-balance volume, the solid line is the raw unbalanced volume, and the dotted line is a moving average of that. You can see it does kick up. So I say that on-balance volume is helpful in picking a stronger stock. And the same is true. I have the rate of change. Not going to work for that one because there's not enough data. There's another example of a similar type of stock, and it shows you where that green line is 3 million a week. And you'll see that that stock did nothing. And then once it's above 3 million a week, it begins to become tradable, I would say. But that's where you'd have to use your own discretion. Do you think that's a stock you want to be in? It's a bit of a penny dreadful on the move. But if you go for the more extreme parameters, those are some of the stocks it would show up. These are the stocks that are currently, so 360 has just come into a new buy. Catapult, these were received yesterday. You can see these are all uptrending stocks. P&I. If you go to the all ordinaries, so this is from one of those spreadsheets from earlier on. You'll see that it did actually pick Appen, which has gone on a screamer in the last little while. And you can see Appen has been in a huge downtrend, represented by this red area. And as it's broken out, the MMA status here has gone to blue, saying, oh, we think the tide has turned on this one. And then we got the R1535, blue is good. Green there is 20, which is a good number. The blue is 60, so this is going screaming up. The breakout, the OBV, is in an uptrend, which is the green line from down here. And the 6% trailing stop has come back into play. It's crossed above that. But in the middle there, you can see there's a failed trade as well. And Robert, I'm open for questions.
Very good, Des. Thank you. That was very good. I had a question. Oh, yeah. While we're waiting for questions, your trailing stop indicator, what does the script code look like?
Okie doke. So let's just pull up a blank screen. Let's go back to that stock 360, which was the one that I've used as this example. Down the bottom here, you can see I've got a TS only, just the trailing stop. It's got some parameters, and that's what that looks like. And the code for that That's the code. So
It's a typical
it's
Des
not as
Bleakley code with a lot of lines in it.
it's not as big and complex as some.
Yeah, that's true.
But I mean, I do run it
Okay.
with half a dozen parameters.
Yeah.
So you can see, and if you look at the parameters, so the first two parameters I have in all my indicators, and that just tells me first test bar is 220 bars ago. That's this line here. That says don't go back any further to analyze, and you can see everything before that line is black. So I'm saying that test bars in the period 0 means from that bar forward. I could put something else in there, and that would give me an entry start point and an end point, and then these numbers here would reflect that. But I normally would run that just with a 0. So some of these things take up code, but they're not really important. There's the percentage down, the 6%.
6, yep.
6%. Minimum volume in this example, I've got 0, so I would allow this to trade anything. But if I put 5 in there, 5 million, that now will get rid of those that are not, in fact, in this one, because 360 has got a huge volume. Yeah, it doesn't, this has always been trading above if I put, I'll pick a number. 60 million. You can see that has killed off some of these trades here.
Yep.
So that's where trading with a minimum values, minimum volume, I think is worthwhile. The other parameter I have here, I'll put that minimum volume back to 5. I have an exit, which I haven't talked about here, but I've put it into this indicator, which I call frothy. And I'll just pull it up.
Frothy nearly rhymes with Bertie.
Yes, it's true. The little airplanes, you see a little green airplane here, and there's a couple more in here. I say a stock has become frothy when it's running at more than 3.7 times the ATR above the average. So it's on an absolute screamer. And then when it drops off that, I then say, oh, it's gone on a bender and let's get out. And this one here, it's a classic example where not only has the frothy said get out, but the stock itself has said that the price has said get out because it falls below the trailing stop. Over here, it's less obvious. There's a couple of frothies that, in fact, where the trailing stop continues. So that code available to everybody, and if you want to change it or do anything like that, I'm happy to help you. That code calculates all of this. The 1535 you see is 42, and the on-balance volume is 18. 42 is a good good value for that. I put a little commentary in here telling you what the stock is doing. So this is the first time it's above the trailing stop, so the blue, it's okay to buy, and the on-balance volume and the rate of change are okay. That means these are both positive. I also, in this example, I say the trailing stop has been at that value, 18.198, for 6 bars. And the reason I do that is if I see this going on for a long, long time and going nowhere, that was 26 bars, I'd say you really shouldn't leave your money in here because it's going nowhere, as an example. Down below is the my volume panel that tells me what the value of the stock trading is. So that's that code. And the matching more complex piece of code is this, but with dollar values put in. So this one calculates the profit, same entry exit points, but calculates the profit on a annualized basis.
All right, and I should put that script up into the Google Drive, yeah?
If you want me to, I'm happy to. Or people come straight to me. What you may find is that if somebody wants to run it, or loaded up, they're probably going to have to come back to me anyway with a few questions. But I'll
They
certainly
might
send this to
too.
you. I'm quite happy to send you all this stuff. The ones though that are maybe of more use to people is things like some of this stuff. The multiple moving averages. So that's the Guppy multiple moving averages displayed on the screen. That's the 12 moving average lines. And I've colored those, the space between those, to be red and green, and actually orange and pink, depending on how they look. That's very complex for a lot of people, and I agree, that is very complex. That same data is that ribbon there. I would suggest that some of those ribbons might be of more interest and more use to some of us, because much simpler. I would never put that detail on the chart, but it's quite helpful to have it like that. And there you see the, as I said earlier on, when this thing goes green, I get it, put a tick on the chart, and that's when I reset the moving average. On balance volume in this form is quite useful. That gives you a real feel for whether the stock is going up. And then I think on balance volume, as its name says, on balance, it's a better view. It's a more concrete. It's just a better measure than the raw volume, which that in raw terms is that. But you can see here that in this central part here, there's actually the volume is increasing quite nicely in a modest sense, and then of course it begins to go a bit bonkers here. So I have got along the bottom here, I have got lots and lots and lots of indicators. This one here is the ribbon that represents the trailing stop. So you can see when the trailing stop is in pink, I've got red here. You don't want to be in here. When it's green, you do want to be in it, and the blue is when it's the first entry point, and so on. So again, that is an easier way to look at this. And if you put these together, I find this very good way to look for things. When you put ribbons together, and you can see these will be very close because they're from the same sort of mindset. But you can say, oh yeah, when this does this does this as well. Oh, when this exits, oh, I don't want to be there. So this putting ribbons up is a great way to look for strategies and to look for coincidences. So anyway, I've got hundreds of indicators if anybody's interested.
One or two might be enough.
Things like, Bollinger Bands are quite complex.
Yeah.
There's Bollinger Bands in a ribbon.
Yeah. Des, thank you for all of that. It's past 9 o'clock. We've been going over an hour. Des, thank you again. On the agenda for tonight, I don't know if anyone's got any particular items to raise or questions. One of the things we usually do is talk about BullCharts tips or questions or issues, or what version are we running, or which one should we run. Does anyone have any questions or things to share related to BullCharts? Something, a feature they might have found that's worth talking about. And while you're thinking about that, after this segment, we'll go back and talk about the share trading game and ask for feedback whether we should do it next year. But for now, BullCharts tips or questions? Dun, 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 dun. Nope. Everyone's mastered it.
Robert,
Okie dokie. Yes, David.
I noticed on Des's charts he's got his time axis at the top.
Yes.
I've had to play around with it, and I can't do that. I presume it's something simple. But how do you do it?
It is now, David and others, I can move the time axis up to the top of the window. There you
That's
go.
it, yeah.
Done. And of course that won't stay like that unless I update my default template to be that.
I had a little question. I
Yes.
updated the BullCharts to 5.1.106, and
Yeah.
several of the rows of like chart tools and things have gone to really tiny little images.
Yeah.
And while other things are big,
Yeah.
and I cannot get the tiny little images to be bigger.
Okay, I suggest you contact Brendan and ask for the link to download 5.1.117.
Okay.
I do believe that 5.1.117 is an update to 106 that does address that sort of problem.
Yeah, okay. So it is a problem. It's not just me.
Yes, no.
Okay.
And it's been
Thanks.
a problem on and off for a number of users for for many months now, with high-res 4K screens or
Yeah.
high-res screens.
Yeah, you need binoculars.
Yeah. Yeah, it's been a problem for a while, but 5.1.117, I believe, should fix it.
Okay, thank you.
The next Melbourne meeting will be Tuesday, the 15th of October, the third Tuesday, and their webinar will be 1 week later on the 22nd, the fourth Tuesday in October. Hopefully tonight's session was useful.